The U.S. Federal Reserve has voted to pause its aggressive monetary policy, leaving rates at 5% to 5.25% for now, after 10 straight sessions of rate hikes over a course of 15 months to crack down on inflation that hit a 40-year high of 9.1% last June. So what has prompted this pause in policy? How high are the prospects of rate hikes going forward? And can more jobs and higher wages hamper the fight against inflation? Welcome to Issues and Insiders. Policymakers at the U.S. Federal Reserve have voted to keep interest rates steady at their latest monetary session. For more on this vote and its broader implications, I have Professor Greg Buchak at Stanford University live on the line. Professor Buchak, it's a pleasure to have you back.
Yeah, thanks for having me back on the show.
I also have Professor Shim Myung-kyu at Yonsei University live on the line as well. Professor Shim, welcome.
Thank you for having me again.
Right, Professor Buchak, as largely expected, the U.S. Federal Reserve has opted for a pause in rate hikes for the first time, I believe, in some 15 months. Do you believe the latest ease in U.S. inflation was the biggest factor behind this move?
You know, I actually think before the latest inflation report, there was some expectation that the Fed would slow down the pace of rate increases. Prior to this month's report, inflation was still elevated, but it was sort of coming down dramatically from its peak last summer. And I think the latest report, where the headline number was 4.1% year over year, kind of sealed the deal. I think there was some interesting language in today's announcement. This was very much phrased as a wait and see kind of decision. The Fed emphasized that holding the rate steady would allow them to sort of assess where things stood. They also reiterated that the 2% long-run target is still far below where we are now in terms of the year-over-year inflation rate. And so there's still a way to go to get to where the Fed would want to be. Another kind of interesting thing that the Fed now puts out are these things called the dot plot. And what this is, it's sort of a graphical summary of what the FOMC committee members' expectations are of rates in the future. And the median forecast for 2023 was 5.5%. That's above today's current target rate, and that suggests the members of the Fed still see raises to come in terms of interest rates.
Right. Professor Shim, for the sake of our viewers who may have missed media coverage of the U.S. Consumer Price Index, do share with us some details about the latest finding.
Yes, so I guess everyone, including economists, has worried about the surge of the U.S. CPI over the last year. And it seems that the situation has become less and less worrisome this year, although we need to be cautious in understanding this observation. In May, the inflation rate was about 4%, and this is a figure that is about 1% point lower than that was in April, and is about half of that in the last year. In particular, it seems that the main driving force behind this is the drop of the energy price. According to the BLS, energy prices become lower by more than 10% from a year ago. And this is why we need to be cautious, because the energy price is much more volatile than the other items included in the CPI. And thus, it can, again, pushes the CPI up if the events like the Ukraine-Russia war continues.
Right, and staying with that, Professor Buchak, data links the slower pace of inflation in the U.S. last month to cooling prices of food and energy, while cars and rent, I believe, reportedly remain the big drivers of inflation. How do you explain this reality?
Well, I think Professor Shim got it exactly right. It's a great question, and as you both mentioned, for this report, food and energy prices move down a lot, while vehicle and housing costs increase. Food and energy prices tend to be very, very volatile, and they often move around in response to what economists sometimes call exogenous shocks. So think of these as sort of surprise events that the Fed really has no direct control over. For a good example, think of like a drought that pushes food prices up, or Russia's invasion of Ukraine causing energy prices to spike. So these prices, they tend to move around a lot. They've decreased recently, but for all we know, another shock could come along and drive them up again. On the housing side, so the U.S. housing market has shown some limited signs of cooling, but connecting this to sort of housing costs that show up in inflation is a little bit subtle. So it's not the house price that matters per se, it's rather the rents or the imputed rents, what economists sort of call the service that the capital provides, rather than the price of the capital good itself, the house. So a very important and pretty unusual feature of the US housing market, and this is something that a lot of my research thinks about, is that almost all houses are owned by people with very long-term fixed rate mortgages. And what this means is if you bought a house when interest rates were 3%, your loan payments don't increase when rates rise to 7.5%, as they have in the mortgage market recently. So that's great news if you don't want to move. But this good news kind of has the perverse effect of locking you into your current house. Because if you do move to a new house, you're going to have to get a new mortgage with more than double the interest rate. So why is this relevant for rental prices? Well, since many people are kind of locked into their current house at a very low interest rate, nobody wants to move. And so very few houses are actually going on the market. And because there's no supply, these house prices remain elevated. And this is kind of compounded by high interest rates. So houses and the cost of homeownership is really elevated, especially if you're a first-time buyer who would like to transition from renting into homeownership. So people like this are sort of caught between a rock and a hard place. Either they pay for a very expensive house with a high monthly mortgage payment, or they remain a renter, where rental prices kind of keep increasing due to this growing demand from a kind of backlog of priced out homeowners. The story is pretty similar on the vehicle side. So like a house, a car is something you have to finance. And as interest rates rise, the user cost of having that car sort of increases. Again, this kind of highlights this tricky aspect of inflation when thinking about things like durable goods like houses and cars, which are a really important component of the CPI.
Right, I see. Professor Shim, back here in South Korea, consumer prices in the country during the month of May also accelerated at a slower pace, with the core inflation rate easing further. What do these findings, Professor Shim, tell us about inflation here in Korea?
So the comment would be similar to what I made for the US. So first, given that the cost of inflation, high inflation is known to be very substantial, the fact that the inflation has become lower this year is kind of the good news for South Korea. In particular, the inflation rate in May was 3.3%, which is about half of that reported in last July. While it is still higher than the target inflation rate of the BOK, which is 2%, the gap between the actual inflation rate and the target inflation rate has become very lower, so that the worry about inflation rate has become lower and lower. But as I pointed out before, and also is pointed out by the Governor Lee several days ago, the core inflation rate has not become lower when we compare with the CPI. This leaves the possibility that there still is a room for the Bank of Korea not to lower the inflation rate, because we need to worry about the possible push-up effect on the CPI again, so that the Bank of Korea, together with the Fed, has to be cautious so that they might increase the interest rate again.
Right, I see. Professor Buchak, before we proceed any further, I should have probably asked you this earlier, but for the sake of layperson like myself, I would like you to expand a bit further on what you talked about earlier. What is meant when speaking about the more volatile components of the consumer price index, like food and energy, as you mentioned earlier, as opposed to the core components of the index, like rent and cars? Why is this discrepancy so important?
Yeah, it's a great question, a really important question. And we've alluded to this a little bit, how energy prices and food prices have been coming down, but other prices have been increasing. So clearly, what you include in your inflation measure, however you measure it, is going to have important implications for whether you think inflation is increasing or decreasing. So to say which measure is relevant, you really need to think about, why are we measuring inflation in the first place? What's the purpose of doing this? Now, these inflation measures like headline or core CPI, they're all an imperfect attempt to measure how much it costs the typical household to consume what they would sort of normally consume in the course of their lives. The headline CPI number, this is kind of the main CPI number that people talk about, it tries to give a comprehensive picture of what a household spends money on. So things like clothes, housing, food, a car, gas for the car, electricity, and so on. Core CPI is that, but it excludes food and energy. And they're both useful diagnostic tools for policymakers and tell them different things. On the face of it, it maybe sounds a little bit silly to think about an inflation measure that excludes food and energy. After all, these are things that households need to sort of live their lives. But on the other hand, for the Fed's mission of long-term price stability, sometimes core inflation is a little bit more of a more useful concept. So there are a few reasons for that. One is, as we talked about earlier, the prices of food and energy just tend to fluctuate a lot. And often they fluctuate for reasons that are a little bit outside the Fed's control, like a natural disaster or war. So that's super important for American citizens, but it's not something that the Fed can directly control through its monetary policy. So it's not clear how much it should factor into the Fed's analysis of whether its monetary policy is having the effect that it intends it to have. The second reason that it's useful to exclude these things like food or energy prices is a lot of these spikes, they're volatile and they tend to be transitory. So it's not clear that the Fed should be worrying about them too much, even if they could control them. So for example, the effects of that drought that might drive food prices up, hopefully that will be short-lived in the next season. In the gasoline price example, gas prices came down to pre-war levels within a year of the Russian invasion of Ukraine. So to sum up, these measures are both kind of important, but they're telling the Fed different and important things.
Right, I see. Thank you for making that clarification. Moving forward, Professor Shim, here in Korea, the broader housing market is slowly recovering, but the Bank of Korea recently shared concerns about related loan delinquencies. Could you explain this for us?
Yes, Governor Lee raised a concern on the household debt several days ago. According to a report by the Financial Supervisory Service released last month, the delinquency rate on domestic banks' won-denominated loans in March was 0.33%. While this figure was slightly lower than that was in February, it is 0.11 percentage points higher from a year ago. In particular, the delinquency rate for the mortgage loans was 0.22%, which is twice of that from a year ago. Given that the interest rate has increased a lot during the last year and still not so good housing market, I guess this is a kind of a negative signal on the aggregate economy. But as I pointed out before, worry over high inflation rate has not disappeared, and hence there is still room for the BOK to raise the interest rate further in the upcoming months. So this will pose further threat on the financial market, and thus the policymakers should be aware of this possibility that there might be a negative shock on the aggregate economy.
Professor Shim, this is an impromptu question, but given that particular scenario, do you believe that the Bank of Korea should seek to keep its rate steady yet again during its next session?
Actually, I have not thought about that deeply, but maybe they have to increase the interest rate although we need to see if the inflation rate will really decline further. But I think we still need to wait and see.
Right, we do.
There are so many uncertainties.
Right, probably. Professor Buchak, back in the US, jobs data shows employment expanding, and in general, workers, I believe, are being paid higher. But some pundits believe this reality may hamper the Fed's fight against inflation. What are your thoughts?
Yeah, that's right. I mean, it's a little counterintuitive to people. Inflation sounds like a bad thing. Rising wages sounds like a good thing. So what's the tension here? And the missing piece is that there's sort of this two-way feedback loop between wages and prices. So why does that happen? Well, turns out labor costs are actually a huge part of the prices that we pay for things. So if I buy a meal at a restaurant, I'm paying for the meat, but I'm also paying for the waiter who brings me the food. I'm paying for the chef who makes the meal. I'm paying for the truck driver who delivered the meat. I'm paying for the pig farmer who raised the pig. I don't know what pigs eat, but I'm also paying for the farmer who grew the pig's food. So when labor costs rise, costs all along that chain rise as well. So increasing wages in some sense sort of necessarily has to lead to inflation. In fact, because labor is such an important input in production of goods, it's a little hard to have large inflation spells without rising labor costs. But then, on the other hand, if prices start to rise, workers start asking for more money to cover their expenses. And so that's this feedback mechanism. Rising prices cause workers to demand higher pay, but higher worker pay leads to higher prices. And this is sometimes referred to as the wage price spiral. So how do you break it? Well, if you're the Fed, you'd like to engineer some kind of slowdown in the economy that reduces the demand for labor. If there's a lower demand for workers, wages won't rise, the whole spiral will be cut short. Now, unfortunately, that's a very difficult thing for the Fed to do right now, given how tight labor market conditions are in the US. Unemployment is at historical lows, and the mostly recovered labor force participation is sort of making things difficult as well. Just aren't enough workers or potential workers. Now, I think sort of a long-term way out of this for the U.S. is probably through something like immigration. And and a lot of people like me would love to see sort of more immigration from young people around the world, especially highly educated young people, people from Korea. Of course, policies and politics sort of slows this down, but I think one of the most effective ways in the long term to combat inflation would be to welcome more immigrants to the U.S. So let me emphasize this sort of counterintuitive thing. It's good in the long term that workers' wages are kind of catching up to some of the productivity gains we've seen over the past decade. There have been big kind of lagging gains in wages until now. But that's certainly something that's frustrating to the Fed from the perspective of fighting inflation.
Right. Professor Shim, staying on the labor front, a concern here in the country is the imbalance in employment, with those in their 60s and above marking remarkable rebounds in job opportunities, while those in their 20s and below have been noting retreats in the job market. What do you suppose, Professor Shim, can be done to better address this imbalance?
Well, actually, this is really a difficult question to address. So I thought about the kind of two possible answers. So one possible solution, which is usually discussed a lot, is to resolve this mismatch problem in the labor market. Particularly in Korea, on average, workers hired by the small and medium-sized firms earn about half of those hired by large firms. So more importantly, the wage gap between these two types of workers has increased over time, which makes young workers looking for jobs posted by large firms, although small and medium-sized firms really want to hire workers. Thus, the resolution of the dual labor market problem would be very necessary to attract young workers to get jobs. Another policy that can potentially address the imbalance in the labor market is to give more educational opportunities to young workers to obtain the skills that are not that easily substituted by the new technologies such as robots or AI. And it is well known that the advanced technology substitute certain types of workers, say the workers performing routine tasks more easily, and thus getting skills that will not be easily substituted by the new technologies would help the young workers to obtain jobs relatively more easily.
Right, I see. Meanwhile then, moving forward, Professor Buchak, both the World Bank and the OECD have raised their global growth outlook for this year. How do you explain the improved outlooks?
Sure. When thinking about changes to forecasts, I think it's important to think about what assumptions in the original forecasts have changed as new data has come out or as uncertainty has been resolved. And first, three things come to my mind. And the first thing is definitely a positive. Following Russia's invasion of Ukraine, you really heard some incredibly pessimistic predictions about the energy situation in Europe. There were people out there saying in 2022 that Europe would run out of energy. They'd be burning wood. People would be freezing to death over the winter. Needless to say, that hasn't come to pass for a number of reasons. First, that winter ended up being quite mild relative to what was anticipated. Second, some new renewable energy sources came online, and Europe started actually using more coal power as well. And third, the US ended shipping an awful lot of natural gas to Europe to close some of these energy gaps. The second big revision I would mention has been the continued resilience of the US economy in the face of rapidly tightening monetary policy that we've been talking about today. This has in some ways been frustrating to the Federal Reserve that's trying to clamp down on inflation, but the continued strength of the US labor market has really kept the US economy growing much more than was expected. Now, going forward, there's sort of this question of whether the Fed and U.S. policymakers can engineer the so-called soft landing, which is getting rid of inflation without entering a recession. There's a lot of uncertainty about whether they'll be able to do that, but at least so far, this much anticipated recession has been a lot slower coming than was expected earlier. And then finally, and I think this is where there's probably the most uncertainty, has been China's exit from COVID lockdowns and the subsequent growth. So growth picked up dramatically in China following its opening up. But now there's a little bit of doubt about the staying power of this recovery. And for that reason, in fact, just recently, the Chinese government has been weighing additional stimulus measures to sort of shore up their economy. I think there's a lot of uncertainty around whether that will actually happen and whether it will have a big effect on the Chinese economy and consequently on the global economy. I think the sort of medium to long-term outlook is a lot murkier, and it depends on how some big global trends go in terms of how sort of global economies can cope with a few things. So one of those big trends is these demographic headwinds where populations are aging and birth rates are falling, and that could potentially be offset by some of these advances in AI or machine learning that Professor Shim alluded to earlier.
Right, and Professor Shim, what are some other variables apart from the ones that Professor Buchak has mentioned that may hinder global growth outlook, global growth this year? And what do you propose to better weather these challenges?
One possible threat on the global growth is the interest rate, is the fact that interest rate is still high because of the remaining concern for high inflation rate. First, as Professor Buchak has pointed out, the threat on the energy price due to the Russian invasion still remains. Second, global warming, together with the war, possibly affect the food prices, and thus the inflation rate might not decline that much this year than you can expect. And this will make the central bank not to lower the interest rate that quickly, which would result in lower consumption and investment, so that it can hinder the economic growth. Second threat is that there is another cost push shock arises from the policies to lower the speed of the global warming. The new technologies to lower CO2s increase the cost of the farms so that the inflation rate does not decrease that quickly. And the third threat that I thought was the possible negative shock from the financial market because of the prolonged high interest rate period. Financial crisis harms the aggregate economy more than the other types of recessionary episodes, as we have experienced from the Great Recession. Given that, as I pointed out before, some of the factors are sort of out of control from the perspective of the policymakers, I would like to suggest that policymakers should and less focus more on stabilizing the financial market so that it can minimize the possibility of the financial market collapse.
Right, of course, and the policymakers at the Bank of Korea hopefully are listening to what you're saying, Professor Shim. Thank you so much for your time and your thoughts, and Professor Buchak, thank you very much for your insights.
Thank you.
Right, well, that is all the time we have for this edition of Issues and Insiders. Thank you for watching.